Welcome everyone, settle in, get comfortable, and let's really get focused. You are joining a comprehensive masterclass explainer today, and it's designed specifically to help you absolutely master the international aspects of UK personal tax for your 2025 BPT exams. I'm going to be your lecturer, and we are going to walk through these rules deliberately, step by step, so you build a rock-solid foundation. I want you to take your time, absorb the material, and just follow my pacing. Today, we're exploring what I like to call the taxpayer's border-crossing life cycle. It's a framework, and honestly, it's the absolute key to navigating these complex, rule-heavy regulations.
Let's take a quick look at our syllabus for today's lecture. We're covering 6 areas. 1. Residence versus domicile. 2. Statutory residence and split years. 3. Remittance basis and exemptions. 4. Calculating double tax relief. 5. Capital gains for non-residents. And finally 6. Inheritance tax and trusts.
All right, let's dive right into Section 1, Residence versus Domicile.
Now, before we look at any numbers at all, I really need you to draw a firm line in your mind. These are two completely distinct concepts, so don't let them blur together. Residence is fluid. It's determined by the statutory residence test, it changes from year to year based on your daily physical location, and it heavily dictates your income tax and your capital gains tax. Domicile, on the other hand, is a deep, foundational legal concept. It's rooted in your permanent home. It rarely changes, and when it does, it's only through deliberate, intentional action. Ultimately, domicile governs your exposure to inheritance tax and your access to the remittance basis.
Let's map out exactly what that tax exposure looks like. If you're a UK resident and UK domiciled, well, the UK taxes everything. That's worldwide income, worldwide gains, and worldwide assets. But consider a taxpayer who is UK resident but non-UK domiciled. Their income tax and CGT are still caught on a worldwide basis, though subject to the remittance basis, but their inheritance tax, that is strictly restricted to UK assets only. So you can see, residence catches the income, but domicile actually shields the global wealth from inheritance tax.
So what are the actual types of domicile? Well, there are 3. First is your domicile of origin. You acquire this right at birth. It is incredibly hard to lose, and it revives automatically if you ever abandon a new domicile. Second is domicile of choice. Please listen carefully here, because to acquire this, you need both physical presence and an intention to remain there permanently. Just moving abroad for a job, no matter how long the contract is, that never creates a domicile of choice if you ultimately intend to come back. Finally, domicile of dependence. This applies to children under 16, and it simply follows the domicile of their relevant parent.
Now, I want to pause right here for a really critical rule, the deemed UK domicile rule. If an individual has been resident in the UK for at least 15 out of the 20 tax years immediately preceding the current tax year, they are deemed to be UK domiciled. Let me repeat that, 15 out of 20 years. Lock that number into your memory. And remember, this applies universally across income tax, capital gains tax, and inheritance tax.
Okay, moving on to Section 2, Statutory residence and split years.
We are now transitioning from a person's legal identity over to their actual physical movement. To count days, we use the statutory residence test, and I have a crucial exam tip for you right here. You must apply this test strictly in order. First, you check Step 1, the automatic overseas tests. If 1 applies, they're non-resident, and you stop. You go no further. Only if Step 1 fails do you proceed to Step 2, the automatic UK tests. Again, if 1 applies, they're UK resident, and you stop. Only if both automatic steps fail do you finally move to Step 3 and start counting ties against days. The golden rule? Stop at the very first conclusive result.
Now, quite often, a taxpayer moves mid-year, right? This brings us to split year treatment, which cleanly separates the tax year into a resident and a non-resident portion. If someone is leaving the UK for full-time overseas work, they actually become non-resident from the very first day they work 3 or more hours abroad. Conversely, if they're arriving in the UK to work, they become resident from their literal date of arrival. And please note this down. Even during a split year, the UK personal allowance can still be claimed in full. It is absolutely not prorated.
All right, let's look at Section 3, Remittance basis and exemptions.
Pay very close attention here, as this is highly testable for the 2024/25 syllabus before the rules change entirely. There's a crucial £2,000 threshold you have to remember. If a non-UK domicile taxpayer's unremitted overseas income and gains stay strictly below £2,000 for the tax year, the remittance basis applies completely automatically. They don't even have to claim it. And wonderfully, they don't lose any of their tax allowances.
However, what if those unremitted offshore funds exceed £2,000? Well, then the remittance basis has to be actively claimed. I'm going to speak slowly here, so you can make sure to write this down. Actively claiming this basis carries severe consequences. You suffer the absolute loss of the personal allowance for that year. You also suffer the loss of the annual exempt amount for capital gains tax. You do have one small lifeline, though, which is business investment relief. This gives you 45 days to invest brought-in funds into qualifying UK companies without triggering a tax charge.
For long-term residents, the cost of the remittance basis gets much heavier. If you've been a UK resident for 7 out of the last 9 years, you have to pay a £30,000 flat charge just to use the remittance basis. And if you've been resident for 12 out of the last 14 years, that charge completely doubles to £60,000. So yeah, these are heavy financial tolls.
Just briefly looking toward the horizon here, from the 6th of April 2025, the remittance basis is actually being abolished and replaced by the foreign income and gains relief. That'll only be applicable for the first 4 years of UK residence. But for your 2025 exams, let me reassure you, this is for awareness only. You really want to focus your heavy revision on the existing remittance basis rules we just covered.
Moving into Section 4, Calculating Double Tax Relief.
I need your absolute, complete focus right now. This is a highly mechanical, process-driven calculation, and getting the steps out of order will cost you heavily on the exam. So let's walk through this strict 4-step method methodically. Step 1, you must always include the overseas income gross of any overseas tax. Do not net it off. Step 2, calculate the UK income tax on the full grossed-up income. Step 3, identify your double tax relief. This is strictly the lower of the UK tax attributable to that specific income or the overseas tax already suffered on it. And finally, Step 4, deduct that relief from your final UK tax liability.
Which brings me to another critical exam tip. If you have multiple sources of overseas income, you absolutely must calculate the double tax relief source by source. And crucially, you always work from the highest overseas tax source first. Why? Well, because UK deductions like your personal allowance are set against UK income first and then overseas income. So by prioritizing the highest overseas rate, you extract the most valuable relief first, which minimizes the ultimate UK tax bill.
Let's jump into Section 5, Capital Gains for Non-Residents.
Generally speaking, non-residents avoid UK capital gains tax, but there is a massive exception when it comes to UK property. Let's narrate this timeline nice and slow. On the 6th of April 2015, the UK started charging non-residents CGT on UK residential property. Therefore, the base cost is usually reset to the market value on the day before, which is the 5th of April 2015. Later on the 6th of April 2019, this net was widened to include UK non-residential property and property-rich assets. And remember, if market value isn't favorable, a time apportionment election is a perfectly valid alternative you should consider in your calculations.
We also really need to define the 5-year trap of temporary non-residence. If a taxpayer was resident for 4 of the prior 7 years, leaves the UK, but then returns within 5 years, they are caught. Any gains realized on pre-departure assets sold while they are away will be fiercely taxed in the year they return. But I want to explicitly clarify something here. If they acquired a brand new asset while they were non-resident and sold it before coming back, that particular asset is completely safe from this rule.
And our final section, Section 6, Inheritance Tax and Trusts.
Okay, I am putting up a rigid signpost right here. Clear your mind of capital gains rules entirely so we avoid any confusion because we are now fully in the realm of inheritance tax. Let's break down these complex timelines, particularly for interest in possession or IIP trusts. The pre- and post-2006 distinction has got to be crystal clear. For IIP trusts set up before the 22nd of March 2006, the assets are simply included in the life tenant's death estate. But post-2006 IIP trusts, those are treated as relevant property trusts, and they're subject to ongoing charges. Keep in mind, setting up most trusts triggers a chargeable lifetime transfer at 20% on anything above the nil rate band. And, vitally, in a discretionary trust, the settlor absolutely cannot be a beneficiary where the assets never actually leave their estate. Now, for those relevant property trusts we just mentioned, they are subject to a maximum periodic charge of 6%. But this charge doesn't happen every year. It strikes exactly on every 10-year anniversary of the trust. Think of it like a slow, ticking tax clock you have to account for.
As we wrap up this masterclass explainer, I want to leave you with a provocation for your exam prep.
When you're sitting there facing a complex, border-crossing taxpayer on your paper, how are you going to systematically sequence their legal domicile, their daily residence tally, and the geographic location of their global assets to pinpoint their precise tax liability? If you can master that sequence, you will absolutely master this exam. Keep studying, stay structured, and I'll see you in the next lesson.